Monday, April 5th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at how physical gold and silver are the Achilles heel of the central bankers, of the banking system, and it has been for many generations. And we're going to start with 1933. Why did FDR issue Executive Order 6102 to confiscate all the gold of the American people, monetary gold that is? Well, because Wall Street, the big banks, back in the 20s, early 30s, they overissued too many liabilities, and they didn't have enough gold to back their liabilities. Gold, of course, was money at the time. You could go with your $10 Federal Reserve note or Treasury note, gold certificate, and go to the bank and get $10 worth of gold. And people realized in 1933 that there was a problem with the banks, and they rushed to get their gold, and there wasn't enough gold for all the paper they issued. So they had to, first, when FDR came to power in March of 33, the first thing he did was proclaim a bank holiday for a week. All that meant you couldn't go to your bank to get your money out, because gold is money. The liability is just a liability, just like JP Morgan said. Gold is money. Everything else is credit. So that was the first step. Stop people taking their gold. And the thing is, people got fooled just like they're getting fooled now with ETFs, with futures. They thought they had gold, but they didn't. So the same thing is going to happen today. 80 years later, people are going to get fooled again. They're going to think they have real gold, and they don't. And am I saying all the ETFs, all the depository institutions out there have done this? No, but if you are concerned, if you have synthetic, as they call, silver or gold with the Perth Mint or with bullion vaults or with any other depository institution, the easiest thing to do is to ask them for delivery. And if they can't deliver to you within a week, maybe two, give them the benefit of the doubt. Then you close out the position. You take your credit out of them. And by credit, I don't mean money, because it's not money. You take your Federal Reserve obligations or your Bank of England obligations, and you go to a proper bullion dealer and you buy the physical. So today I wanted to show you something that came out from WikiLeaks back in 2005. They leaked this document from, I think it was 1974, and it was correspondence between financial and monetary affairs between the UK government and the US government. And they were concerned because in 1975, as of January 1st, 1975, Americans were going to be allowed, after 42 years, they're going to be allowed to own gold again, to buy gold. And they were concerned that especially big investors were going to start buying a lot of physical gold. They didn't want that. They weren't too concerned, it seems, with the small investors who were going to buy a coin or two here and there. But let's go through this leak, this document that was leaked. So it says here, Economic Affairs, Financial and Monetary Affairs, UK, United Kingdom, US, United States. So it says, the announced auction of official gold by the US Treasury was praised by London gold dealers as being timely and highly contributory to a more stable market. For these people, a stable market means that they don't want to see the price go up, right? That's what they mean. Some fear, however, that should a single bid for the entire 2 million ounces be forthcoming, prices might increase rapidly, possibly as high as $250 an ounce. They anticipate, and this is to do with the legalization of gold in the States, they anticipate major impact of U.S. ownership will be the formation of a sizable gold futures market. Sizable, but rather small demand for physical holding of gold other than coins after a brief initial surge following deregulation. So here they go on about the U.S. sales of treasury gold. And they had a problem because the Arabs were like hoovering up these auctions like there was no tomorrow. So it didn't really work. In London, to private ownership of gold by Americans, ASST Finite obtained reactions from major London wholesale gold dealers Samuel Montague, Sharps Pixley, Makata Goldsmith, and Consolidated Goldfields to announce auction of gold by U.S. Treasury. While the underlying reason deferred, the consensus of the dealers was that the move by the U.S. was laudable. In most cases, they stated that the action was unexpected. The timing of the decision was praised as being foresighted. Announcement of the sale prior to January 1st, 1975. Date was viewed as timely since there is a mounting evidence that much of the recent increase in the price of traded gold has resulted from anticipation of a large American demand following the deregulation date, even though the dealers themselves expect the physical demand to be rather short-lived. This much said, a recurring comment both in conversations with the gold dealers as well as in numerous telephone calls received by the embassy is that if one buyer or more, likely one buyer from a particular country, Kuwait was often cited, decided to place a bid for the entire 2 million ounces of US gold being auctioned either at market prices or possibly at higher than market prices, then the effect of the U.S. auction, which is initially viewed as having a stabilizing again, keeping the price down, force on the on market prices would be the opposite. Yeah, and that's what happened because people wanted gold, especially the Arabs and the Middle Eastern countries. Dealers stated that should such a single bid be accepted by the U.S., then the markets would interpret this as a signal that heretofore unrecognized demand was present and prices would increase rapidly, possibly as high as $250 per ounce or even higher. In the dealer's view, the only counteraction to the above hypothetical situation would be for an immediate announcement of an additional sale of like or larger quantities. The dealers with whom we spoke stated that to date there had been no significant activity in the gold markets by official monetary authorities of Arab countries. They also expressed the view that should market conditions indicate that prices may rise rapidly in the near term, a large volume purchase from oil producing area should not be totally discounted or unexpected. So let's go here to the interesting part where they talk about the futures market and what it was really created for, and why I've told people that they need to not play the paper game, because you just add fuel to the fire, to the manipulation. It says here towards the end of this leak document, to the dealers' expectations will be the formation of a sizable gold futures market. Each of the dealers expressed the belief that the futures market would be of a significant proportion and physical trading would be minuscule by comparison. There you go. The paper market. You're forecasting that already in 1974. Also expressed was the expectation that large volume futures dealing would create a highly volatile market. In turn, the volatile price movements would diminish the initial demand for physical holding and most likely negate long-term hoarding by U.S. citizens. So that's what they use the futures market for. And I've said that many times, to create volatility, to scare the general public, the US citizens, but also citizens from all other countries. And what about ETFs and these depository institutions? They're synthetic products. Well, it's the same game. It's a paper game. They want to discourage people from buying real physical, because they know that gold and silver, without gold and silver in the banking system is finished, because gold and silver are money. And many people still don't realize that. I'm going to get a lot of questions. Oh, what about PSLV? What about this ETF? Forget it. In my opinion, you can go ahead and do it, but you need to make sure you're able to get delivery. Some of you might not want delivery. Some of you might want to keep playing the banker's game, and that's your problem. But don't tell me I didn't warn you when everything unravels. Here's the last paragraph. As to future demand by U.S. citizens for gold, most dealers did not foresee demand for physical holding as significant, with the exception of an initial surge during the first 2 to 3 months of the year following deregulation. They did not feel that U.S. citizens on the whole were psychologically prepared to switch from small-scale gold coin purchases to large-scale long-term bullion hoarding. Several express the view that the demand for coins after initial surge would most likely be such that it could be met from within should the US decide to mint gold coins for such purposes. So there you go. That's the game. That's the futures. And I've said that many times. They will even drive the price up to sucker people in and then smash it down, so people get discouraged. And that's why I've said many times, it's a long-term prospect having physical gold and silver. You need to sit through the pain. But since then, gold has gone from like $35 an ounce to over $2,000 last year. So the tendency, of course, is for fiat currencies to get devalued versus gold, because they create fiat currency almost ad infinitum these days. And gold and silver, of course, are scarce commodities. They can't be conjured up out of thin air. So just to give you an idea, this is a bank note, Bank of England note, and it says, I promise to pay the bearer on demand the sum of £10. And it still says that today. So before World War I, you could go, let's say, with one of these, a £10 Bank of England note, and you could go to any bank and say, I want £10 in money, in gold. So they would give you 10 sovereigns, right? So that's that's not cash. That's the credit note, and that's the money or cash, right? A lot of people get that wrong. That's the currency. That's the paper currency. It was convenient, but it had to be backed, right? Or else the bank was bankrupt. And I would say that, that's the money. That can be currency as well, because you could use that to pay things in commerce. And, that was money and currency. That was only currency. So that puts that question of money, gold, paper currencies to rest. And so how do I buy or acquire physical gold and silver? Well, there is the physical. As for silver, you can get bars like these. This is a 100-gram bar, which I got a few weeks ago from Gold Investments. And you've got the bullion coins like this, 1 ounce bullion coin. I think this is a shield, 1 ounce silver shield. There you go. That's a 999 coin. It's very pure. Then you get also the bigger bars. This is a 50 troy ounce bar, Anglo hard bar. And then you get the junk silver. or constitutional silver like the Morgan dollar, and you can get silver that's circulated as money in other countries like in Brazil in the 1800s. You can get pre-1920 circulating coins from the UK, which are sterling, like this florin. So there's many ways to do it. The best way to find out about it is go on the internet, Google, learn as much as you can. I try to let people know, of course, about these things. But the purpose of this video, of course, is to let you know that the only way to really defeat this fraudulent fractional reserve monetary system, well, it's not even monetary because there is no more money involved. They don't give you gold and silver. It's been a bankrupt system for many generations, unfortunately. People actually think that this is money, but you can only extinguish a debt like this by paying in gold or in silver as well. When someone pays you with that, they are extinguishing a debt between them and you, but the Bank of England still has a debt, and that's the whole problem with this system. And they try to keep this fractional reserve system going within precious metals. They don't want the public to get out of the system, and that's why they also created the ETF, or these depository institutions like Bullion Vault, the Perth Mint. Perth Mint, I'm not sure how long they've been allowing people to deposit or have a synthetic gold and silver with them. Bullion Vault, if you look at their history, and I'm not saying that Bullion Vault doesn't have the gold and silver. If you have gold and silver with them, allocated or unallocated, you have to talk to them and say, do a test, because I have an account with them I opened years ago, but I have nothing in it. So you have to contact the companies that you think you have gold or silver with them to make sure that you can get that out. So yes, and the ETFs were started out about 15 years ago because I think the monetary authorities, the bankers, they knew that there was going to be huge demand, and they wanted to keep people away from physical. And as I've said, we need to get physical. That's the only way to defeat the bankers. So with that, let's quickly look at where the markets are this morning. It's 8:24 a.m. London. We've got spot gold at 17.26. It's down just over $3. The high has been 17.40, the low 17.21. Silver is down 22 cents. And this is all the paper market, of course, controlled by these people still. But I think they're going to become irrelevant very soon. The Comex, the LBMA. We just have to keep chipping away at their physical supply. And it might seem a daunting prospect for small investors, but if we get together, if we multiply in thousands, 100,000s, and millions, it's going to be very hard for them. Silver is down yet 22 cents at 24.72. Low's been 24.60. High 25.06, so down just under 1%. Stock market is virtually unchanged. The Dow future up 22 points. The Nasdaq is down 0.25%. S&P is down 3 points. The currencies, pound is virtually unchanged, 138.29. The euro is down 0.1%, 117.45. The dollar is unchanged versus the yen, 110.64. Dollar is up slightly versus the yuan at 6.58. High-grade copper is up 0.75% at 4.06. WTI crude is down 1% at 60.65. The 10-year yield is at 1.72%, up about 4 basis points. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great start to the week. Take care. Bye.